Chapter 3: Fundamentals of Market Analysis. Key economic indicators and their impact on trading. Economic indicators serve as crucial metrics, offering profound insights into an economy's health and direction, profoundly influencing trading across different financial markets. Gross domestic product, GDP. In-depth understanding of GDP. GDP measures a nation's total economic output, encompassing all goods and services produced within its borders. Impact on trading the currency markets. A robust GDP growth typically strengthens a country's currency. For instance, if a nation's GDP growth surpasses expectations, it can attract foreign investments, elevating the value of its currency. Impact on trading the stock markets. Positive GDP growth often aligns with increased corporate profits and economic expansion, fostering optimistic sentiments in stock markets and potentially driving stock prices higher. Consumer Price Index, CPI. Complex dynamics of CPI. CPI gauges changes in the prices of goods and services purchased by consumers. Impact on trading the currency markets. CPI fluctuations significantly influence central bank policies, particularly interest rate decisions. Higher CPI can prompt central banks to implement tighter monetary policies, potentially strengthening the currency. Impact on trading the stock markets. Elevated CPI may signify increased production costs for companies, potentially impacting profit margins and triggering market volatility. Unemployment rate. Unraveling the unemployment rate. The unemployment rate represents the percentage of the labor force without employment. Impact on trading the currency markets. High unemployment rates may weaken a currency due to reduced consumer spending, lower economic growth prospects, and potential political implications. Impact on trading the stock markets. Elevated unemployment rates can dampen consumer confidence, potentially leading to decreased consumer spending and affecting corporate earnings and stock market performance. Interest rates. Comprehensive insight into interest rates. Interest rates, controlled by central banks, determine borrowing costs and influence economic activity. Impact on trading the currency markets. Higher interest rates generally attract foreign investment seeking better returns, potentially strengthening a nation's currency. Impact on trading the stock markets. Rising interest rates can elevate borrowing costs for businesses, affecting corporate profits and potentially leading to market volatility. Purchasing Managers Index, PMI. In-depth examination of PMI. PMI reflects the economic health of the manufacturing sector. Impact on trading the currency markets. Positive PMI figures can strengthen a currency, signaling economic growth and potential increases in export activity. Impact on trading the stock markets. Elevated PMI often indicates an expanding manufacturing sector, benefiting manufacturing companies and potentially contributing to stock market gains. Retail sales. Thorough analysis of retail sales. Retail sales represent consumer spending at retail establishments. Impact on trading the currency markets. Strong retail sales figures may strengthen a currency, indicating robust consumer confidence and economic growth. Impact on trading the stock markets. Increased retail sales often translate to higher revenues for companies, potentially boosting corporate earnings and positively influencing stock prices. Trade balance. Deeper insight into trade balance. Trade balance signifies the difference between a nation's exports and imports. Impact on trading the currency markets. A positive trade balance indicating higher exports than imports may strengthen a currency due to increased demand for the country's goods and services. Impact on trading the stock markets. A positive trade balance can positively impact companies reliant on exports, potentially contributing to stock market gains. A meticulous understanding of these key economic indicators and their impacts on currency, stock, and other financial markets is pivotal for traders. These indicators not only reflect economic performance but also guide traders in anticipating market trends, volatility, and potential investment opportunities. By closely monitoring and analyzing these economic indicators, traders can fine-tune their strategies, optimize risk management approaches, and capitalize on market opportunities across diverse economic landscapes. In forthcoming chapters, we will delve into advanced strategies, methodologies, and real-world applications of these economic indicators in trading, providing traders with the necessary tools and insights to navigate dynamic markets successfully.